Setting up a business or a holding structure in DIFC or the Dubai International Financial Center can be a smart move, but it's also easy to get things wrong. DIFC follows its own rules, and even experienced people often make mistakes that cost them time, money, or credibility. In this video, we'll go through 7 common mistakes people make when setting up in DIFC. We will talk about choosing the wrong structure, banking problems, privacy issues, and more. So you can avoid these traps and build a solid future proof setup. Before we start, my name is Shiraz Baid and I'm the founder at Lepidus Wealth, where we help clients and families protect their assets using a range of tools including trust, foundations, wills, and offshore structures. So if you own a business or real estate, don't wait until a legal or health crisis to start thinking about protecting what you have built. Instead, request your free and customized asset protection plan by clicking the link below. You can then implement it step by step as your journey progresses. Now, starting with the first mistake, that is assuming that a DIFC company works like a free zone entity. Many clients believe that they can simply set up a company and use it for any kind of business or structuring purpose. But DIFC is a regulated financial center with its own legal ecosystem based on the English common law. That means the rules around permitted activities, ongoing compliance, and governance are very different. If you're setting up for investment holding, for example, you don't need a full commercial license. But if you're offering services even to companies outside of Dubai, you may need full regulatory approvals. Not knowing this upfront can cost you both time and credibility. Even more critically, choosing the wrong type of entity at the start can complicate your ability to adapt the structure later without incurring additional cost or needing full restructuring. Another mistake is underestimating the role of DIFC registrar. The registrar is not just a formality. This office actively reviews, questions, and sometimes rejects structures that don't align with their guidelines. This includes things like ownership arrangement, nominee structures, or complex offshore layering. Unlike some offshore jurisdictions where you simply pay and file, DIFC takes a more rigorous approach. If you plan to hold a foundation or SPV, it needs to be justifiable and coherent in its purpose. Trying to outsmart the system usually backfires. We have seen even experienced lawyers forced to revise submissions because they overlooked important details that were important to the registrar's expectation. This is especially true for cross-border structures that involve sensitive jurisdictions or layered control mechanisms. Clients also make the mistake of neglecting substance. Just because DIFC is often used for wealth and succession structures doesn't mean it's a paper jurisdiction. If your structure is being used to hold assets, manage investments, or serve as part of your global family office, you may need local substance. That could include having a resident director, maintaining a physical presence, or demonstrating decision making in Dubai. This is especially important if you want your structure to stand up to the international scrutiny or to open bank accounts later on. Simply naming a nominee director without showing real engagement may raise red flags. And as global tax transparency increases, regulators and banks are becoming more focused on where decisions are actually made, not just where entities are registered. Now, let's look at another frequent issue, that is mismatched banking expectations. Many people set up in DIFC assuming they can automatically open a local or international bank account. While DIFC has a reputation for compliance and credibility, banks still conduct their own independent due diligence. They want to see clarity of purpose, real activity, source of funds, and sometimes personal presence. If your entity has no local substance, unclear beneficiaries, or no clear rationale for banking in the region, your applications may be delayed or denied. It's important to plan your banking strategy before incorporation, not after. And remember, different banks prioritize different risk factors. Some are more comfortable with holding structures, while others want to see operating revenues. If your strategy depends on banking, align it early and revisit it often. The fifth mistake I want to discuss is the wrong structure for succession planning. DIFC offers both companies and foundations. Each serve different purpose. If you're planning to hold family assets, create multi-generation structures, or define beneficiary rules, then a DIFC foundation may be more suitable. Using a company for this can result in confusion around control, share transfer, and beneficiary designation. We have seen clients restructure later at significant cost because they set up a company when a foundation would have provided more clarity and legal continuity. Foundations also allow you to separate control from benefit, a key distinction when managing assets for future generation or multiple branches of a family. Another area where clients go wrong is misunderstanding privacy. DIFC offers a high level of confidentiality, but it is not a secrecy based jurisdiction. Shareholders and directors are recorded, and regulators have access to ultimate beneficial ownership information. If you are coming from background of opaque offshore structures, this may feel intrusive. But the point of DIFC is to be compliant, bankable, and internationally respected. You can structure your privacy within the law, but attempting to hide ownership or control through proxies or unnecessary layering often draws more attention. In fact, several high profile banking rejections in recent years comes not from the structure itself, but from the attempt to disguise it. The seventh mistake is setting up without a long term plan. DIFC is not a low cost jurisdiction. While it offers prestige, legal certainty, and access to global banking, the ongoing cost and compliance requirements are real. If you are setting it up to just check a box or because it seemed like a good idea, you may find the structure burdensome over time. We always advise our clients to look for 3 to 5 years ahead. Ask yourself that will this still serve my goals if I move jurisdictions? If tax rule changes, if I need to raise capital or pass assets to the beneficiaries. Structures without a long-term rationale tend to fall apart at critical moments. As I mentioned earlier, if you own a business or real estate, don't wait for legal or health crisis to start thinking about protecting your wealth. Many people think asset protection is only for ultra wealthy. But the reality is that some of these solutions cost as much as setting up a free zone company in Dubai. If you want to secure what you have built and ensure your legacy, you can request your free and customized asset protection plan by clicking the link in the description below. And if you're serious about building long term financial security, you should really check out my next video right here.